This is this is Papa's Real Estate Podcast. So we do this every week to come up here and talk about real estate. Well, if you're new to this channel, welcome. This is Papa's Real Estate channel, and my name is Pafode. If you are a returning guest, well, welcome back. Thanks for stopping by. Please, all of you, like, subscribe, comment, share. Let me know what you think, so we can get this to a wider audience, a variety of audience, a broader audience, so they can all learn a thing or two. On today's real estate podcast, our main focus topic is going to be about interest rates versus housing prices, either they go up or down. All right. In the United States, the Federal Reserve sets the interest rates for the bond market, and then all the other stuff, which in turn affects the real estate mortgage interest rates. They don't really actually set the mortgage interest rate, but they're all interrelated. It's complicated, including your car note interest rate, your credit cards, and all the other stuff. So how it works is that the Federal Reserve will dictate the rates for the bond market and also for their overnight repo markets and all the other stuff that they do, which trickles down and affects the interest rates on the houses and cars and all the other stuff. Anything that's loan related. In the United States, as we can see, this is March of 2022, housing prices being at the highest level they've ever been before. Interest rates have been at the lowest level they've ever been before since they start tracking interest rates. So you got these two things going on. Higher housing prices are way out there off the roof of the chain, and interest rates are rock bottom. This makes it affordable for a lot of people can afford a lot more housing, meaning like a $400,000-$500,000 house for a payment that is relatively in the 2,000 range up to 3,000 in some cases, because of the interest rate is low. Let's say interest rate is at 3% and you get a $500,000 home and you're paying less than, most likely, about close to $3,000 a month. All right, let's put it that way, at $3,000 a month. If that same $500,000 home is there for sale and interest rate goes from 3% into the 4%, that will add a significant amount of money on your monthly payment. Let's just say another $400 a month or $500 a month. I'm not doing math in my head to tell you what the exact numbers are, but I'm just giving you an example. So somebody whose budget is looking at less than $3,000 on a housing cost every month, because that's what they can afford. If the price stays the same at $500,000 and the interest rate goes up 1%, that would push a lot of people out of the affordability range. Okay, that's an argument right there. And there's another group of people with the argument saying that if interest rate goes up, it's going to bring housing prices down. Actually, if you look at it, there's not been a correlation directly to say when interest rates go down, housing price go down. When interest rate goes up, housing prices goes up. It's not there. It's just a scarcity that we have to say that if interest rate goes up, it's going to push a lot of people out of affordability. And if a lot more people are not buying houses are going to sit on the market longer. And if they sit on the market longer, it's going to force the buyers to reduce their price. And if those buyers reduce their price, it might end up crashing the housing market. Then everybody else have to reduce their prices, and the appraisals will come back down lower because they're going by the recent sales. Then that's something one can say the Feds will crash the housing market. But in most cases, the Feds interest rates going up higher will not, in my opinion, crash the housing market. Anyway, please like, subscribe, let me know what you think. And if you have any other comment to put underneath, please do. And if you have argument to make, please do. Thanks for stopping by, and we'll see you next time.